Welcome back to the channel. Today we are going to talk about Bollinger Bands, one of the most visually striking and practically useful indicators in technical analysis. Bollinger Bands were developed by the legendary technical analyst John Bollinger in the 1980s and have since become one of the most widely used indicators by traders and investors around the world. By the end of this video, you will understand exactly what Bollinger Bands are, how they work, and how to use them to make smarter trading decisions. Let us get started. Bollinger Bands consist of three lines plotted directly on the price chart. The middle band is a simple moving average, usually the 20-day moving average. The upper band is plotted 2 standard deviations above the middle band. The lower band is plotted 2 standard deviations below the middle band. Now do not worry about the mathematics of standard deviations. What it simply means is this: the upper and lower bands automatically widen when the market is volatile and narrow when the market is calm and quiet. This expanding and contracting behavior is what makes Bollinger Bands so unique and useful compared to other indicators. They adapt dynamically to changing market conditions. One of the most powerful signals generated by Bollinger Bands is called the Bollinger Band Squeeze. A squeeze occurs when the upper and lower bands come very close together, meaning the bands have become very narrow. This happens when the market has been unusually calm and quiet for an extended period. The squeeze is significant because periods of low volatility are almost always followed by periods of high volatility. In other words, when the bands squeeze together, it is like a spring being compressed. The tighter the squeeze, the more powerful the eventual breakout tends to be. When the bands start expanding again after a squeeze, it signals that a significant price move is beginning. Traders watch for the direction of the breakout to determine whether to buy or sell. Another important use of Bollinger Bands is identifying overbought and oversold conditions. When the price touches or moves above the upper Bollinger Band, the stock is considered to be trading at the high end of its normal range, potentially overbought. When the price touches or moves below the lower Bollinger Band, the stock is considered to be trading at the low end of its normal range, potentially oversold. However, and this is very important, in a strong uptrend, prices can walk along the upper band for extended periods. This is called riding the band, and it actually confirms the strength of the uptrend rather than signaling a reversal. Similarly, in a strong downtrend, prices can walk along the lower band. So always consider the broader trend context before interpreting a touch of the upper or lower band as a reversal signal. One of the most practical trading strategies using Bollinger Bands is called the Bollinger Band Bounce. This strategy works best in a sideways or ranging market, when the price is moving back and forth between the upper and lower bands without a clear trend. The idea is simple. When the price touches the lower band and shows signs of bouncing back up, it can be a buying opportunity. When the price touches the upper band and shows signs of pulling back down, it can be a selling or profit booking opportunity. The middle band, the 20-day moving average, often acts as a magnet that the price tends to return to after touching either extreme. Combining the Bollinger Band bounce strategy with a candlestick reversal pattern at the upper or lower band gives you a much more reliable signal than using Bollinger Bands alone. To summarize, Bollinger Bands consist of 3 lines: a middle moving average, and upper and lower bands that expand and contract based on market volatility. The Bollinger Band Squeeze signals that a big move is coming. Prices touching the upper band may be overbought and prices touching the lower band may be oversold, but always consider the trend context. And the Bollinger Band Bounce strategy works well in ranging markets where price moves back and forth between the bands. Bollinger Bands are one of the most versatile indicators available. They tell you about both trend, direction, and volatility at the same time. Add them to your chart alongside RSI and moving averages, and you will have a very powerful combination of tools at your disposal. If you found this video helpful, please like and subscribe for more content on stock markets and economics. Thank you for watching, and I will see you in the next one.